While you were reading this sentence, a digital bank just acquired another one of your potential customers. Not tomorrow, not next week, right now. And they did it at a fraction of your operational cost. I'm Victoria Chen from Advanedge Consulting, and today we're diving deep into the cost equation that's reshaping banking. This is episode 2 of our 5-part series on why digital banks are winning and what traditional institutions can do about it. The numbers don't lie. Digital-first banks are operating with cost-to-income ratios of 20 to 30%, while traditional banks struggle to get below 60%. That gap isn't just a statistic, it's an existential threat. Every day this gap widens. Digital competitors gain more resources to invest in customer acquisition, better technology, and lower pricing. Meanwhile, traditional banks are trapped in a cycle of legacy costs that make meaningful competition nearly impossible. Here's what most banking executives miss when they look at digital transformation. They see it as a technology upgrade, install some new software, launch a mobile app, maybe add chatbots, and suddenly they think they're competitive with digital natives. But that's like putting a fresh coat of paint on a horse and expecting it to compete in Formula One. The institutions we work with consistently underestimate the depth of their cost disadvantage. A regional bank we recently helped transform was spending $47 to acquire each new checking account customer. Their digital competitor? $12. Same market, same demographic, but completely different cost structures. The problem runs deeper than marketing costs. It's embedded in every operational layer. Traditional banks carry decades of accumulated complexity, multiple legacy systems that don't talk to each other, manual processes that should have been automated years ago, compliance frameworks built for a pre-digital world, and physical infrastructure that digital banks simply don't need. One institution we worked with was maintaining 17 different systems just to process a single loan application. 17. Each system required separate maintenance contracts, specialized staff, and custom integrations. Their loan officers were spending 60% of their time on data entry and system navigation instead of actually serving customers. Meanwhile, their digital competitors were approving loans in minutes with automated workflows. This complexity tax shows up everywhere, in IT budgets that consume 20 to 30% of operational expenses, in training costs for systems so complex that new employees need months to become productive, in compliance costs that multiply with every additional system and process, and in opportunity costs. Because while traditional banks are managing complexity, digital banks are innovating. Now let's talk about how the technology leaders are actually solving this. And it's not what most people think. The transformation isn't about adding digital features to existing systems, it's about rebuilding the entire operational foundation. Core banking modernization is where this battle is really won or lost. The big 3 providers, Fiserv, Jack Henry, and FIS, serve roughly 70% of U.S. banks, but most institutions are using outdated versions of these platforms. We're talking about systems implemented 10, 15, even 20 years ago, running on legacy configurations that were never designed for real-time digital experiences. Here's what we've seen across multiple transformations. Banks that fully modernize their core systems typically see operational cost reductions of 30 to 50% within 18 months. Not because they're cutting jobs, but because they're eliminating redundant systems, automating manual processes, and creating operational efficiency that was impossible with legacy architecture. Artificial intelligence is the force multiplier in this transformation. We've helped institutions implement AI-driven fraud detection that processes transactions in milliseconds instead of the minutes or hours required by traditional rule-based systems. Customer service AI that handles 60 to 70% of routine inquiries, freeing human staff for complex relationship management, and predictive analytics that identify at-risk customers before they defect, not after. Blockchain technology is quietly revolutionizing back-office operations. One institution we worked with reduced their correspondent banking costs by 40% using blockchain-based settlement networks. Another eliminated 2 full days from their trade finance processes. These aren't flashy consumer features. They're fundamental cost reductions that go straight to the bottom line. Digital payments infrastructure is where the cost leverage becomes most visible to customers. Traditional banks often charge customers for services that digital banks provide free because their cost structure allows it. Real-time payments, international transfers, mobile check deposits, these become profit centers instead of cost centers when built on modern infrastructure. In lending, institutions that implement best-in-class loan origination systems like Abrigo are seeing dramatic improvements in efficiency and competitiveness. Abrigo's platform streamlines the entire lending workflow, enabling faster decision-making, better risk assessment, and significantly reduced processing costs. We've seen institutions cut loan processing time from weeks to days, while actually improving their risk profile through better data analytics and automated workflows. So what can traditional institutions do right now? First, audit your true cost per customer across all products and services. Most banks we work with are shocked by what this analysis reveals. They're losing money on products they thought were profitable and missing opportunities in segments they thought were unprofitable. Second, prioritize integration over addition. Before implementing any new technology, create a plan to eliminate the legacy systems it's replacing. Every additional system increases complexity and cost. The goal isn't digital features. It's digital efficiency. Third, embrace API-first architecture. This allows you to integrate with Fintech partners and modern systems without rebuilding everything from scratch. We help institutions create integration strategies that reduce implementation time by 60 to 70%. Regulatory compliance doesn't have to be a cost burden in the digital age. Modern regulatory technology can automate reporting, monitor compliance in real time, and actually reduce regulatory risk while cutting costs. We guide institutions through compliance automation that typically saves hundreds of thousands of dollars annually, while improving regulatory outcomes. The institutions that will thrive in the next decade are those that recognize a fundamental truth. Digital transformation isn't about keeping up with technology trends. It's about achieving operational excellence that makes superior customer experiences profitable rather than costly. Traditional banks have advantages digital natives can't easily replicate. Established customer relationships, regulatory expertise, local market knowledge, and trusted brands. But these advantages only matter if they can deliver them through cost structures that enable competitive pricing and service levels. The cost of waiting is higher than you think. The next video proves it.